Okay, we're all set.
Okay, great. Thank you, Craig. Welcome everyone, and thank you for attending today's hearing. I'm Brad Bobin, the Chief Actuary of the Maryland Insurance Administration. This is the Maryland Insurance Administration's first regular public hearing in 2025 on specific carrier rate increases for long-term care insurance products. Today's hearing is going to focus on rate increase requests from 3 different carriers currently in the individual market before the MIA. These include requests from Bankers Life and Casualty Insurance Company proposing a rate increase of 20% for policyholders on forms GR-N520, N540, N550, and N570. John Hancock Life Insurance Company, USA, proposing a rate increase as follows: 41.8% on form ICC 10 LTC 11, a 41.9% increase on form LTC 03 Maryland 610, a 42.9% increase on form LTC 06 Maryland, a 35% increase on form LTC 03 MD 108, a 121.6% increase on forms LTC 02 MD and BSC 02 MD, a 108.1% increase on forms LTC 96, MD 996, LTC 96 MD 397, LTC 96 CL MD 996, LTC 96 CL MD 397, NH99 MD 499, and LTC 2000 MD 400. And finally, they are asking for a 50% on forms LTC MD 91, NHMD 91, LTC 94 MD, LTC 94 MD 94, and NH 94 MD. Finally, Massachusetts Mutual Life Insurance Company is proposing a rate increase of 280% for policyholders on form MM200PMD, MM300PMD, MM400PMD, and they're requesting a rate increase of 89.2% for policyholders in forms MM500-PMD, MM501 PMD, and MM5P-1 MD. These requests in aggregate affect 14,452 Maryland policyholders. The purpose of the hearing is for the insurance company officials to explain the reasons for the rate increases being requested, and for the MIA to consider whether the proposed increases are in compliance with Maryland's laws and regulations relating to long-term care insurance. We will also listen to comments from consumers and other interested parties. We are here to listen and ask questions of carriers and consumers regarding the specific rate increase requests. I'd like to take a moment to introduce the folks who are here with me from the Maryland Insurance Administration. On my panel, I have Jin Shin, who is Senior Actuary, and Antoinette Najiki, who is Assistant Actuary. I'm going to go over a few procedures that we would like to follow today. When it is time for public comments, we will call first on the members of the public who registered to speak in advance. Then, to the extent the time and technology permit, the MIA will hear from unregistered participants who access the Zoom webinar platform or who have attended a hearing in person. If using Zoom, you can communicate with us through the chat function. With the exception of MIA staff, this hearing is not a question and answer forum. Comments from interested parties were received and reviewed in advance of this meeting. The MIA will continue to keep the record open until Tuesday, March 18th, 2025 for additional written testimony. A video of today's meeting, as well as all written testimony submitted, will be posted on the MIA's website on the long-term care page. The long-term care page can be found on the MIA website by clicking on the Consumers tab at the top of the homepage and then clicking the long-term care link. To please help ensure excellent sound quality throughout the hearing, we ask you please stay on mute unless you are speaking. Also, anytime before speaking, if you could restate your name clearly, that would be greatly appreciated. We'll be asking the carriers to speak first regarding a rate request. Afterwards, interested stakeholders will be invited to speak. I will now turn it over to the carriers and allow them the opportunity to discuss their pending rate increases. First up, we have Bankers Life and Casualty Insurance Company. From Bankers, we have Mr. Charles Bartley.
Christopher Bartley, I believe.
Yep, Chris Bartley.
All right, Chris. I'll turn the floor over to you.
All right, thank you. Good afternoon, everyone. My name is Chris Bartley. I'm a senior actuary in the Health Product Management Department at CNO Financial Group. I am responsible for, among other things, reviewing experience on and making recommendations for the long-term care business at Bankers Life and Casualty Company, which is the largest insurance company under the CNO Financial Group umbrella. On behalf of my company, I'd like to thank you for the opportunity to provide information regarding our recent request to increase premiums on one of our older long-term care insurance policy forms, the N550 series. Before discussing the details of the filing, I would like to provide some background info on the LTC business at my company. Bankers Life and Casualty currently insures more than 200,000 members nationwide, approximately 3,600 of them in Maryland, under a long-term care, home health care, nursing home, or short-term care policy. We've been writing business since 1987, and we remain actively selling new policies today, having issued around 220 new policies in Maryland in 2024. At Bankers Life, we are proud of our commitment to offering meaningful insurance coverage to middle market consumers at and near retirement, and we believe our long-term care and short-term care products are an important component of our policyholders' financial security in their retirement years. There are approximately 155 policyholders or 188 insureds in the state of Maryland who are insured under the policy series for which we are requesting the increased premiums. These insureds were issued between 2005 and 2009, and on average have been in force for about 18 years as of the present time. Nationwide, we've been pursuing 2 rounds of rate increases on this block for an ultimate rate level goal of 38%. In the state of Maryland, a 15% request was approved and implemented in 2016. As such, we are requesting that Maryland approves a 20% premium rate increase to bring the Maryland rate premium in line with the nationwide rate level. We believe the equitable thing to do is to continue to pursue rate actions in states that have not yet approved the full amount of our prior rate actions, with the goal of ultimately achieving a rate parity across the nation. We understand that increasing premiums can be difficult for insureds who are on fixed incomes, and we make a point to personalize each notice of a premium rate increase with options for policyholders to consider. These include paying the increased amount, or if the current coverage is above the minimum benefits we offer, reducing coverage by increasing elimination period or reducing the benefit period. In addition, each policyholder is invited to call a 1-800 number to explore other possible benefit reductions that may be available to them if the specific personalized options described in their rate letters are not satisfactory to them. We understand that policyholders may wish to spend time considering the options available to them, so our current practice is to notify policyholders of an impending premium rate change at least 60 days in advance of the change. We submitted the financial projections to the Maryland Insurance Administration, documenting the actuarial justification for the 20% premium rate increase we are requesting. The policy form's projected lifetime loss ratio at Maryland's current rate level is 68.7% and decreases to 66%, assuming the premium rate increase is approved. Additionally, based on our current projections, the allowable rate increase under the 5885 test is significantly higher than the 20% requested. The policy form series, subject to this rate increase, has accrued experience since inception that is fully credible on a nationwide basis, but is not credible for Maryland alone. Therefore, the experience data and analysis performed on this block utilizes a nationwide experience. Bankers Life and Casualty believes it's both in our company's interest and our policyholders' interest to continuously monitor our business and work with regulators to adjust premiums as quickly as necessary to enable us to maintain a financially stable book of business and honor our commitments to our policyholders to be able to pay their claims when they arise. We look forward to continuing to work with Maryland Insurance Administration on this filing and any others that may be required in the future, with the goal of meeting our shared objective of keeping the LTC business at Bankers Life and Casualty financially sound and stable. Thank you again for providing me with the opportunity to speak with you today. I appreciate the opportunity to engage in the dialogue on this important issue, and I am happy to answer any questions.
Brad, do you have any questions? If not, I can address question now.
Yeah, sorry, I was muted, but yeah, if you want to go first, please go ahead.
Yeah, hi, Chris.
Hello.
Thank you for your explanation for the, proposed rate increase of 20%. Looking at your current experience, it's running at around, you mentioned 68.7% for the lifetime loss ratio. Comparing against your originally priced loss ratio, I assume around maybe 64, 65%. It seems like your current experience loss ratio is not running, too far off from your original price loss ratio. And there are still, a lot of uncertainty associated with the projection of future loss ratio. So I was wondering if your rate request of 20% at this time is a little bit premature, if I may say. Your 20% rate increase would improve only 2% improvement in your lifetime loss ratio from 68% to 66%. So I wanted to know what you think about, my thinking that it might be a little bit too premature.
Yeah, I understand that. Definitely in the context of rate increases and thinking about a 60 something percent lifetime loss ratio compared to when a lot of other rate increases are needing much larger increases to handle their business that's like over 100% loss ratios. And I understand that, but we're in some of our blocks of business that aren't quite our legacy products that are a little more newer. We're trying to be proactive and take the small steps when they seem necessary. When they deviate a little bit, we're trying to not allow things to build up to where we eventually need to request, a 50% increase or higher in the future. So we're trying to take the small adjustments as we deem it as it pops up. So we're trying to be, I think it's actually justified that a rate increase is needed, and we are trying to be proactive in letting a lot of experience build up in this current rate deficiency, so it gets worse over time.
Mm-hmm. Yeah, I understand. Thank you.
Thanks, Chris. As far as what the original original pricing loss ratio was, do you have that? Jen was assuming it was 64 or 65%, but do you know what it actually was?
Yeah, I think we provided this in
Yeah, yes, you did. I think it hit a range of from 62% to 65%.
yeah, according to the data we sent, we gave the specific by policy form instead of the series, but yeah, they range from about 62% to 65%.
Okay, and do you know what profit assumptions were built into those?
At the time of initial pricing, I don't have that information right now.
Well, actually, you sent that information
Oh
as
yeah,
well. 7%.
yes, I do actually. Sorry,
7.1%.
7.1% is what we have in our objection.
7.1%. All right, thank you. And so you said that the 20% you're asking for would bring us in line with other states and bring us up to the overall average approved rate level. Is that fair characterization?
Yes, we've had two separate full rounds of rate increases to try to target a 38% cumulative level. And we're actively pursuing this nationwide to get those states to the level two where they're not already there.
Okay. And if this increase was approved, would you intend to pursue any further increases beyond this?
Further increases beyond this would only arise if there's a deviation of experience from our current assumptions.
Okay, thank you. Those were all the questions I had. anything else from my team? All right, I don't think so. So thank you very much.
Yep, thank you.
All right, next, would the representative from John Hancock Life Insurance Company please speak?
Good afternoon. My name is PJ Beltramini, and I'm a Vice President and Actuary at John Hancock, responsible for long-term care insurance in-force management. I'm in good standing with the Society of Actuaries and the American Academy of Actuaries. Brad, Jim, Antoinette, and Craig, thanks to you and the rest of the team for holding today's virtual hearing and for providing John Hancock this opportunity to discuss our long-term care filings currently pending with the Maryland Insurance Administration. We understand that it is difficult for insurance departments to balance the impact on their constituents while maintaining private market for long-term care needs, so we appreciate your time on this matter. John Hancock began selling long-term care insurance as a guaranteed renewable product in the state of Maryland in 1987. We currently insure over 20,000 long-term care customers in Maryland and have paid out more than $775 million to Maryland families as of December 31st, 2024. Nationwide, we pay over $2 billion of long-term care claims per year. We take our commitment to our customers very seriously. This includes making significant ongoing investment in our service capabilities, as well as piloting wellness programs with the goal of helping our customers live healthy and independent lives. I'm here today to speak specifically about our long-term care premium rate increase filings pending with the MIA. John Hancock understands premium increases can be difficult for customers and appreciates the opportunity to explain why these rate increases are needed. I will also discuss the various options we offer to mitigate the rate increase and how we will communicate these options to our customers. We currently have 7 rate increase filings with the MIA for multiple policy forms that were sold in Maryland between 1991 and 2012. The rate increase request amounts range from an average of 35% to 122%, depending on the policy series. These filings were submitted on January 15th, 2025, and will impact approximately 11,000 Maryland insureds. Acknowledging Maryland regulation, John Hancock would be willing to work with the MIA to implement the requested rate increases over multiple years with no more than 15% in each year. I want to explain why we need these rate adjustments. John Hancock is committed to helping ensure long-term care insurance benefits will be there for our customers when they need them most. To uphold this responsibility, we continuously monitor the experience of our in-force long-term care insurance policies and conduct a comprehensive claims study generally every 3 years to examine the usage trends for our insured population. Relative to previous expectations, the new data in our 2022 comprehensive claims study found lower mortality for non-claimants, higher utilization of benefits, and longer claims, partly offset by lower claim incidence. Based on that data, as well as data from previous studies, we've determined that there is a need to increase premiums on certain policy series so we can meet our future claims obligations. Our rate requests also reflect the timing of the acceptance of our prior rate increase filings in Maryland, as well as any unapproved amounts from our prior filings on an actuarially equivalent basis. I would now like to turn to how we can help our customers mitigate the impact of a rate increase. We are aware that customers appreciate alternatives, and we are committed to providing our customers with options which will help them mitigate the impact where possible. We provide the standard benefit reduction alternatives to mitigate the impact of premium increases. These include reducing the daily benefit, reducing the benefit period, increasing the elimination period, or dropping optional benefits. Additionally, when we receive a full or substantially full approval of our requests, we are able to offer most customers one of our actuarially equivalent mitigation options: inflation landing spots or shared cost. As I mentioned, we acknowledge the rate limitation of Maryland regulation, but would respectfully ask that you consider implementing the requested rate increases over multiple years with no more than 15% increase in each year, so that we can offer these meaningful options to our customers. The first option, known as the Future Inflation Reduction Landing Spot, offsets the rate increase for those with fixed automatic inflation increases by lowering the future inflation increases on a prospective basis. The customer retains their current daily benefit amount and any past inflation accruals, and only the future accruals are reduced. Our second actuarially equivalent mitigation option, called shared cost, also provides a meaningful alternative to our customers. This option is particularly beneficial for older customers who have paid many years of premiums, because the ratio of future benefits to future premiums is higher for those individuals. And the higher that relationship, the lower the shared cost benefit reduction has to be in order to offset the rate increase. The shared cost option has two components. First, the current policy maximum benefit amount, including the daily or the monthly amount as applicable, will be reduced by the shared cost percentage. And second, the customer will agree to pay the shared cost percentage, which is similar to a coinsurance percentage on every future claim. We recognize that these options are, in fact, benefit reductions. Nevertheless, they provide viable alternatives for customers who may choose not to pay the premium increase and do not want their coverage to lapse. We understand the value of these policies and fully appreciate the inconvenience and potential challenges that these rate increases present for our customers. We believe in clear communication with our customers, describing the need for these rate increases and the options available to mitigate the increase. As supporting documentation to our rate filing, we have submitted a sample customer communication package regarding the rate increase and the options to help mitigate the rate increase. We developed this communication package, keeping in mind the amount of meaningful and detailed information to the customer and the presentation of the material in a clear manner. We have incorporated suggestions from state regulators, customers, and our dedicated customer service representatives. This package will be personalized for each customer with reduction options to keep their premium at or near the current level. Options will vary by their respective situation. In conclusion, putting our customers first has been and continues to be a critical component to everything we do, and we appreciate this opportunity to address our current filings with you. I would be happy to answer any questions you might have.
Thank you. So you said the inflation landing spot and the shared cost options are only for if we approve the full increases being proposed. Otherwise, they won't be available. Is that
for a full or a substantial rate increase?
full or substantial? All right. And do you have any idea of what percent of members you expect to take these enhanced RBOs based on how you've offered in other states?
Historically, we've offered these and they've been taken in total about half the time. Now, that does depend on the amount of the rate increase and the history of the rate increase, but that's what we've benchmarked to for our election rates.
Thank you. Do you have any questions?
Yeah. So, what would you say was the most critical or biggest factor in your mispricing at the original, launching of these policies? I'm sure it was combination of lapse, higher incidence rates, or claim duration. But what would you say was the most critical factor in producing different experience compared to what you originally priced for?
Yeah, thanks for the question. We had our series, as Brad outlined at the start, cover a variety of years. And for the earliest series, a lot of it was due to lapse rates, the lapse rates being lower than we originally anticipated. Towards some of the more later series, it's more on the claim assumptions that have been higher than we originally priced. So for the older series, there's some amount that's for claims and a relatively significant amount for lapse, but for the more recent series, it's more on the claim assumptions.
Yeah, and then looking at your rate increase history, during like last 12, 13 years, we allowed 15% rate increase max every single year. So that ends up like 300% over the last 12 years. And, Maryland policyholders can no longer afford this, high premium, going from like $2,000 to $3,000 annual premium to almost $10,000, approaching $10,000 annually. And, and they're forced to keep reducing their benefits, and they have very limited options. So I would, I just putting myself in the position of Maryland policyholders. I mean, what can they do? I mean, 15% annual increase every year, which is like 5 times the inflation rate. So I was wondering, how would you resolve this situation if you were like Maryland policyholder?
So I talked a bit about the options that we offer to the policyholders and recognizing the fact that many of them have been subject to significant rates. We've developed these options to provide alternatives that will allow them to keep their premium level at the current rate.
And looking at the different programs, looks like the LTC 02 and LTC 96, those are the two biggest programs, and Maryland policyholders have most of the policyholders in those two forms. Why are they running worse, or why are they deteriorating faster than the other programs, if I may ask?
So I wouldn't say that they're deteriorating faster or differently necessarily. A lot of it may go back to the initial pricing and the timing of the rate increase requests. So it's not necessarily that there's a material difference from one study to the next. It's sort of that cumulatively it's had a bigger impact across those older series.
Okay, so the rate request of like 121.6% for the LTC 02 and the 108% rate increase for the LTC 96 was maybe due to underpricing compared to the other programs, or?
I wouldn't necessarily say it's it's underpricing or more underpricing. Some of the reason that those are more significant is the timing of the rate increase history. For each of them, we generally target the same lifetime or the lifetime loss ratio that we targeted in our most recent filing.
Mhm.
And so if you look at the change in the assumptions from one assumption basis to the next, they're relatively similar for those series. So it's more the cumulative impact over time.
Okay, thanks.
Okay, thank you, PJ. That's all the questions we have. Appreciate your time.
Thank you.
All right, and finally, we have a representative from Massachusetts Mutual Life Insurance Company.
Hi, good afternoon. Can you hear me okay?
Yeah, we can hear you great.
Great, thank you very much. My name is Dominic Ianno, and I'm the head of state government relations at Mass Mutual. Also with me on the call today is Missy Gordon, who's principal and consulting actuary at Milliman. Mass Mutual retained Milliman to perform actuarial analyses and prepare rate filings on our behalf for our standalone long-term care block of business, which we are discussing today. Missy also prepared remarks to share today regarding the filing and is available to help with any questions. On behalf of Mass Mutual, I first want to thank you for the opportunity to discuss a request for an in-force premium increase on our 200 to 400 series and 500 and 511 series individual long-term care insurance policies. We appreciate Commissioner Grant and the Maryland Insurance Administration's time this afternoon and the continued partnership. Seeking a rate increase is not a step we take lightly. However, we have made the difficult decision to file these rate increases due to market and regulatory conditions, plus claims experience to ensure that the policy rates will meet maturing population and cost pressures. Before turning it over to Missy to discuss our request, I want to first provide a brief background on Mass Mutual's long-term care business. Mass Mutual is a mutual life insurance company established in 1851 in Springfield, Massachusetts, and we began selling long-term care insurance in 2000 with our Signature Care 200 series. Since releasing that first product, Mass Mutual has introduced 6 subsequent series: Signature Care 300, 400, 500, 511, 513, and 600. Mass Mutual discontinued selling all standalone policies in 2021. The 2 filings we're discussing today pertain to the 200, 400 series and the 500 and 511 series. The 513 series is not included in this request as it was filed separately, and the Maryland Insurance Administration approved a rate increase in July of 2024. The company is not requesting a rate increase on the most recently issued 600 series at this time, but we will continue to monitor that business accordingly. Once again, I'd like to thank the administration for this opportunity to speak here today, and now I'd like to turn it over to Missy at Milliman for her comments.
Thanks, Dominic. Good afternoon. My name is Missy Gordon. I'm a principal and consulting actuary at Milliman. As Dominic said, I was retained by Mass Mutual to perform actuarial analyses and prepare the rate filings on behalf of Mass Mutual for its standalone long-term care business. On behalf of Mass Mutual, thank you again for the opportunity to discuss the request on an in-force premium increase for its 200 to 400 and 500 to 511 series individual long-term care insurance policies. This rate increase request is part of a second nationwide filing on these policy forms that began in 2023. The first nationwide request in 2018 sought to achieve a rate level consistent with that on the company's 513 product, which was capped at a maximum increase of 100%. In jurisdictions that did not approve the initial increase as requested, the company requested follow-up increases to target lifetime loss ratios that were actuarial equivalent to the 2018 request. As part of the first nationwide request, the Maryland Insurance Administration approved in September of 2020 a series of reduced phased-in increases for the 200 to 511 series that varied by inflation option, benefit period, and issue age. The approved increases averaged 47% and were phased in at 10% or 12.5% per year for 2 to 4 years. Consistent with what other carriers have found, and we know you have heard many times, the company's emerging and expected experience is running more adverse than originally expected. More specifically, as described in our filing, lower mortality and lapse rates result in a much larger pool of expected long-term care claims. Additionally, we expect higher morbidity, which is from a combination of higher than expected incidence rates and longer than expected claim durations. Interest rates are not a factor for the request in either filing, even though interest rates have been lower than originally expected for the 200 to 400 series filing. Given these considerations, MassMutual has made the difficult decision to file for additional rate increases on this block of business. These rate increases would mitigate losses expected to emerge in the future. MassMutual is not seeking to recover any past losses already incurred. For the first nationwide request, the 200 to 511 series were pooled together. However, the company is now managing the block separately by rate series when reviewing experience and determining when a rate increase is needed to be pursued. Therefore, the second nationwide request has separate filings for the 200 to 400 series and 500 to 511 series. Consistent with the first nationwide filings, the company intends to pursue actuarial equivalent rate levels in all jurisdictions. The rate levels in each jurisdiction vary by rate series and inflation option, and were developed with consideration for the prior rate history of each jurisdiction. The first rate increase filing that we'll be discussing today is on the 200 to 400 series, which were issued in Maryland from September 2000 to November 2008. As shown in this filing, these products cover more than 2,600 lives in Maryland and 37,000 lives nationwide. The request varies by series and inflation protection option and averages 280%. The second rate increase filing is on the 500 to 511 series, which were issued in Maryland from April 2008 to February 2013. As shown in this filing, these products cover more than 600 lives in Maryland and 19,000 lives nationwide. The request varies by series and inflation protection option and averages 89%. So we acknowledge that the requested rate increase exceeds the 15% annual maximum required by the Code of Maryland regulations. However, once the company and the administration have come to agreement regarding the requested increase, an actuarial equivalent phased-in increase will be determined that limits the annual increases to 15%. While this current request is being sought to help alleviate the adverse performance on this business, approving this increase as requested will not constitute a rate guarantee, as MassMutual reserves the right to request additional increases in the future. MassMutual understands the difficulties a substantial rate increase can present to a policy owner. As shown in both filings, if the full requested rate increase is approved, the projected lifetime profit loss ratios continue to be negative. MassMutual has and will continue to share in the financial responsibility of paying all policy benefits. As of year-end 2023, MassMutual is holding statutory premium deficiency reserve of $3.8 billion direct before reinsurance and $185 million net of reinsurance for its long-term care blocks in total. MassMutual believes it's very important to clearly communicate to its policy owners upon regulatory approval of a rate increase impacting their premiums. Once MassMutual implements any new premium rates in its administrative systems, the company will send a formal increase notification at least 60 days prior to the effective date of any rate increase, with clear options available to impacted policy owners. The notification period will provide policy owners time to consider their individual circumstances and options available to them to make sound, informed decisions about their coverage. MassMutual is sensitive to the impact that rate increases have on its policy owners affected by the premium increase, and have the option to reduce their policy benefits to provide flexibility of choice for those who wish to maintain similar premium level. The benefit reduction options available to an individual policy owner to mitigate the rate increase may include reducing the daily benefit amount, extending the elimination period, reducing the benefit period, reducing the amount of automatic inflation protection, and/or removing optional riders. The company administers the reduction or removal of automatic inflation protection in a consumer-friendly manner that exceeds industry norms. Insureds who elect to reduce or remove their automatic inflation protection keep their inflated or their current daily benefit amounts, and their premium rates are determined using reduced inflation protection option factor and their uninflated or original daily benefit. This allows for these insureds to significantly mitigate a rate increase as their premiums are based on their uninflated or original daily benefit while maintaining meaningful long-term care coverage, as they will retain all daily benefit inflation accrued to date. MassMutual is also voluntarily offering a contingent benefit upon lapse to all insureds affected by the premium increase, even if the increase is not considered substantial. In closing, MassMutual thanks you again for both this afternoon and throughout this process. We appreciate your expertise and important role you play in serving Maryland's insurance customers and balancing difficult issues like this. MassMutual wants to ensure this process goes as smooth as possible for its policy owners and you, the regulators, and we commit to a transparency and promptness throughout the review. Thank you for allowing me to participate in today's hearing, and I'm happy to answer any questions.
Thank you, Missy, for your comments. When I was looking at the SURF and your actual memorandum, the total requested rate increase were different. SURF was showing 280% for the series 200, 300, and 400, whereas your actual memorandum had 193%. Is it because of the difference in evaluation date?
So
Or-
the cover letter shows the rate increase that's being requested in Maryland. And then the actual memorandum shows the rate increase that's based on nationwide actual experience. So the request in Maryland differs because, again, the company is pursuing actuarial equivalent rate increase in each jurisdiction that considers the historical rate increase of that jurisdiction.
Okay, thanks.
Mhm.
And another question I had was, why such a heavy, very large rate increase this time around? You know, instead of proactively managing the program and requesting smaller increase, more, frequently. I was just surprised why such a large increase in this time.
Yes, yeah. And again, it was a difficult decision. The company looked at a number of different methods in evaluating the rate increase. The rate increase is developed using one of the methods that was approved by the NAIC MSA method, which is the prospective present value method. So it's looking just prospectively on the rate increase. And they looked at other methods like the Minnesota method that was also in the NAIC MSA method at that time in 2023 when they developed the nationwide request. And that one was actually showing a much larger rate increase. So they had chose the prospective present value method as part of developing the rate increase.
Okay, thanks.
Mhm.
Another question I had was, is the 500 series more richer plan than compared to 200, 400 series? What's the main difference? I mean, you mentioned about inflation option, but is there any other benefit structure difference between those two different series?
Yeah, the key difference between the 500 and 511 is that one is a participating forms versus the 2 through 400 are non-participating. And then also in the 2 through 4, there's a lot more lifetime benefit period and inflation options versus in the 500 and 511, there was much less lifetime or not offered lifetime benefit options.
Right, right. And 2, 3, 400 series are running a lot worse than 500 series, right?
Mhm, yes, correct.
And 500 series are newer programs.
Correct. Yep. So those would have had higher premium rates as well because of it was priced more recently.
Okay, great. Thank you.
I didn't have any questions, so thank you for your testimony. Appreciate it.
Thank you very
Thank you.
much.
At this point, we're gonna turn it over to public testimony. Craig, I know we had 3 people sign up to speak in the public. I don't know if they have joined and are
Yes,
Or,
Mr. Cohen is
available?
now in the panelist side, so he's ready to speak.
okay. You're cutting in and out. It's hard to hear you.
So Mr. Cohen is now in the panelist side. Mr. Cohen, can you hear me? Mr. Cohen?
Can you hear me now?
Yes.
Yes, we can hear you.
Thank you. I appreciate the opportunity to participate in this hearing. It is actually very interesting to see something like this. Apparently, this type of insurance policy, while I realize that when we took the policy out, it did allow for rate increases. I just had absolutely no idea of the magnitude that might be requested. But I would like to make a short statement, if I may. My wife and I have had a MassMutual 300 series long-term care policy since 2005. 2 years ago, I believe, the company requested a rate increase, which was granted, and the impact of that decision raised our annual premium to by about 21%. But given the numbers I'm hearing today, that's chump change. By any measure, to request an additional rate increase at this time, at this amount, 2 years later, is unconscionable. I mean, either the actuaries then didn't know what they were talking about, or they don't know what they're talking about now, or maybe they just don't know what they're talking about. The point is that over the years, one would think that they would have a policy and a premium structure which makes sense and is viable. But to say, well, we need to increase the premium by something like 300% I've listened to this testimony. No one, of course, has a smile on their face, and that's for good reason. But I just cannot understand how they could claim that they were so far off then, or maybe they're that far off now. I don't know. Your notice contains the following statement. The purpose of this hearing is for insurance company officials to explain the reasons for the rate increases. The reason is obvious for anybody paying attention, however covered by actuarial detail. It's bad enough that these types of products allow for rate increases, but that was always the understanding up front. It is, however, the responsibility of the Maryland Insurance Administration to protect our citizens from rampant price gouging, and I suggest that, on its face, a request of this nature at this time, so close to a 21% rate increase, is just that. My wife and I are retirees. For many of the holders of these policies, inflation is a constant concern, one to be taken very seriously. We are not talking about a dozen eggs here. I realize, per your notice, that the scope of the upcoming hearing is limited to, quote, whatever the proposed rate increase, not specifically identified at the time, is in compliance with Maryland's laws and regulations relating to long-term care insurance, close quote. I am hopeful, however, that the law governing the hearing includes a test of fundamental fairness, because if that is the case, this request by MassMutual, as is, must fail. And that really ends my comments. I again want to thank the Insurance Administration for allowing me the opportunity to speak.
Brad, you're on mute.
By the way, if anybody has any questions of me, I'm just a retired lawyer but a citizen of the state of Maryland. And I'd be more than happy to give you my perspective if I have not made it clear to this point.
Thank you, Mr. Cohen. We appreciate your testimony. I think you made your point very clear. And it's certainly a valid point. You know, the 280% increase is certainly a large number. That's far in excess of the rate increases that the Maryland Insurance Administration tends to approve. And you know, I will just stress that these are all just proposals. We're gonna finish our review and we're gonna,
I understand, and I have to applaud Ms. Gordon for being able to make this request with a straight face. It just doesn't make sense.
Thank you, Mr. Cohen. I definitely hear what you're saying.
Thank you.
Ms. Sylvia Rams is in the panelist side and ready to speak. Ms. Rams, can you hear us? Ms. Rams? Ms. Rams, can you hear us? You are unmuted now, but perhaps can you hear us? Okay, there appears to be some technical difficulty with Ms. Rams. And I believe that's all we have signed up. You want to put a call out for anyone who's in the audience who would like to comment.
Did we have a Miss Betty Legundo join that Nancy had emailed about today, or did she not able to make the call?
She is not in the attendees.
Okay.
Ms. Rams is unmuted now, so maybe she's ready to speak.
Ms. Rams? Yeah, we cannot hear.
Okay.
Yeah.
All right. What should we do then, Craig? Should we go ahead and
Yeah, we could go ahead and open it up, and if anyone wants to speak, that they can tell us in the chat or just raise their hand.
yeah, if there's anybody else listening that wants to speak, please just raise your hand or speak in the chat.
Brad, I'm not seeing anyone. Ms. Rams, one more time, can you hear us? Okay, Brad, yeah, I'm not seeing anyone who would like to comment.
All right, then I guess we can wrap things up. As a reminder, the written testimony is open until Tuesday, March 18th. So anybody who was unable to testify or who wants to provide some written testimony in addition to oral testimony, we're taking submissions until Tuesday, March 18th. All right, thanks everyone very much for the hearing today. I appreciate your time.
Thank you.